My name is Brian Johnson, and I am a former institutional investment manager with over 30 years of experience in the financial markets. I am now a full-time derivatives trader. This is the first in a series of videos that will demonstrate the use of the option strategy hedging and risk management spreadsheet that accompanies my recent in-depth article of the same name. The 120-page article, which is closer to a short book, represents a comprehensive analytical framework and accompanying spreadsheet tools for managing and hedging option strategy risk. Specifically, the framework can be used to hedge option strategy exits and adjustments. In addition, the framework can also be used to identify the most cost-effective black swan hedge solutions using actual VIX call options and actual put options on the underlying security. These practical new hedging tools can be applied to any option strategy in any market environment and should be used with all option income strategies. The primary purpose of this video is to demonstrate the first component of the option strategy hedging and risk management spreadsheet, which is position sizing. Now, let's review the spreadsheet. There are 5 tabs: terms, holidays, position size, futures hedge, and equity put hedge, all located at the bottom of the spreadsheet. This video will deal exclusively with the terms and position size tabs. The first step is to accept the terms and affirm that you have purchased the article and are entitled to use the spreadsheet. This is accompanied using the drop-down boxes on the terms tab of the spreadsheet. At this point, we are now ready to use the Position Size tab to calculate the position size examples. The position sizing formulas are well known by most experienced traders, and they are provided in the article. Position sizing is critically important and is a prerequisite for risk management. We will review position sizing in this video demo. The remaining videos in this series will break new ground in option strategy hedging. All of these videos will only provide a simple demonstration of how to use the spreadsheet tools that accompany the article. The article includes a comprehensive discussion of the framework and methodology used in the spreadsheet, including several of the formulas. Cells with blue backgrounds represent user input cells, such as the ones you see here at the top left and towards the middle of the spreadsheet on the left. I will begin by defining several of the terms. The first thing you'll notice on this tab of the spreadsheet is that several of the calculated cells contain the word value with an exclamation point. The reason for that is that when I opened the spreadsheet, I had not yet accepted the terms. So we've already accepted the terms at the beginning of this video, but we still need to enter a value in one of the user input cells to force all of the cells to recalculate. So now you'll notice by entering the value 1,000,001 and then returning it to a million in the cell B4, I was able to force all of the remaining cells to recalculate and get rid of that word value in the calculated cells. Now let's continue with the definitions. So value, the value of cell B4 is 1,000,000. That represents a hypothetical total dollar amount of trading capital, or the value of our portfolio. The next cell is which is B5, is the total dollar capital at risk, or total percentage of capital at risk. In this case, it's 2%. What that means is that if we were to lose the maximum planned dollar amount on the trade, we would only lose 2% of our total capital. And the reason for that is the more capital we lose, the harder it is to recover. So for example, if we were to lose 50% of our total capital, it would take a 100% return on our portfolio to return to break even. As a result, the key to risk management is to keep our trading losses small. So in this particular example, I have limited the total loss on our entire capital position to 2%. Now, the cell immediately below that B6 is listed at 20%. What that says is that we are going to exit our trade position once we've incurred a maximum loss of 20%. If we do incur a maximum loss on 20%, the question is, and we want to maintain our desired total capital at risk of 2%, what position size can we accommodate? In this particular case, we can accommodate a position size of 10%. Again, the formulas are provided in the article, but in this particular case, we see that if we have a 20% loss on a 10% position, the resulting loss would be 2% of our entire capital position. Or said differently, if we have a position size of 100,000 and we incur a loss of 20,000, then that would result in a $20,000 loss of our entire capital position, which again would represent 2% of our $1 million trading account. So the top of the spreadsheet, position sizing tab of the spreadsheet, allows us to calculate the desired position size given a total amount of trading capital, the maximum total capital at risk, and the maximum loss on the specific trade. Now, the bottom side of the spreadsheet allows us to do somewhat of a what if or hypothetical analysis. So this says that if we incurred a 20% actual loss on the trade, which is, again, consistent with the 20% loss we expected on the trade, and instead of having a 10% position size, we actually had a 20% position size. So in other words, our position size was significantly larger than planned. We would incur a 4% actual total capital loss. So basically it says that if we doubled our actual position size relative to our calculated position size, then the total capital at risk would increase from 2% to 4%. Let's go through a second position sizing example. We'll use the same $1 million total amount of trading capital, but this time we'll increase the desired capital at risk from 2% to 5%. We'll reduce the maximum loss on the trade from 20% to 10%, which will give us a position size of 50%, meaning that we could actually allocate 50% of our trading capital to this position if we ensure a maximum loss per trade of 10%, and if that were to actually happen, in other words, if we were to lose 10% loss on the trade on a 50% position, we would lose 5% of our desired total capital. Now that's usually a little bit larger than we would like to have. In other words, it would incur more risk than we would normally like, but we'll use it in this particular example. So again, a 50% position size incurs a maximum loss of 10% on the trade, would result in a 5% loss of our total capital, or in this case, $50,000. Now let's go through the what-if analysis. In the what-if analysis at the bottom of the screen, I'm going to assume that we use the recommended position size of 50%. Instead of a 10% actual loss on the trade, this time I'm going to assume that we have actually a 100% loss on the trade. So in this case, if we actually use the calculated and recommended position size of 50% as our actual position size, but instead of the 10% loss, we incurred an actual 100% loss on the trade, we would lose 50% of our trading capital. That's the same example that I mentioned before, which would require a 100% return on capital in order to return to break even. So what happened? What happened was that we had an invalid assumption. We intended to limit the maximum loss on the trade to 10%, but we actually incurred a maximum loss of 100% on the trade. Can this happen in practice? Absolutely, especially as it applies to option income strategies, which use a variety of leverage. In other words, we incur losses that exceed the loss we plan to incur on the trade. A lot of these can actually occur from overnight gaps, which are fairly normal and unpredictable. They can also occur from extreme black swan events. As a result, Hedging tools are required to manage option strategy risk in order to ensure that our actual maximum loss will not exceed our planned maximum loss. These hedging tools are included in the remaining spreadsheet tabs and are explained in detail in the article. They will be the topics of the remaining demonstration videos in this series. For now, let's review several of the resources that you might find useful in your trading and research. The primary purpose of this video was to demonstrate the first component of the option strategy, hedging, and risk management spreadsheet, position sizing. My first 3 option books are listed at the top of the resources page. If you are interested in learning more about these publications, you will find Amazon links for each book in the right sidebar of the Trader Edge website. All books are available in print and ebook formats on Amazon. On TraderEdge.net, you will also find blog posts and links to discount offers from affiliates, all of which I use in my proprietary trading. Finally, Trader Edge also offers a monthly subscription to the OIS Universal Filter, which is a proprietary algorithm that is used to objectively rank entry and exit environments for option income strategy or OIS trades. The filter is discussed extensively in my recent publication, Option Income Strategy Trade Filters. I hope you found this spreadsheet demonstration helpful. If you have any questions, you can contact me via email at bjohnson@traderedge.net. Thank you.